I feel I owe an apology. So for years, I've had my business for 20 years, and I started off as someone who would train you to show you what really works. So when you needed to, you knew how to do what you were supposed to do, right? Past knowledge, right? It was going to be a behavior that you actually did when you were supposed to. And I've often talked about how the big box advisor world creates confusion and overwhelm and complexity where none is needed. But then they swoop in as the hero to solve that complexity that they created. And then on the other end, you have the do-it-yourself world that's led by the pick of the month newsletter world, which they do the same thing. They create an incredible amount of complexity, overwhelm, confusion, and then they swoop in as the hero saying, but wait, we have the perfect thing for you. We have the gold newsletter or the China newsletter or the deep value newsletter or the Bitcoin, I guess it'd be the cryptocurrency newsletter or the marijuana millionaire newsletter. But the outcome is the same. Lots of ticker symbols, lots of great stories, lots of old ideas like diversification and rebalancing and just finding the right ticker symbol. And I come along and say, it's much easier than that. It's much easier. Diversification stopped working. Rebalancing stopped working. Most people have not noticed. And I basically said, it's just own fewer ticker symbols. But here's the apology. What I'm clear about is, even if you have the right ticker symbol, right? If you don't have the right investment, then it's really all of your problem. Really, it's 100% of your problem. But if you do have the right investment, let's say it's buy the S&P 500 with dividends reinvested, then you've solved basically 5, maybe 10% of your problem, knowing where to have it. But the problem is you're left with this other 90, 95% of your problem, which is, how do I behave? How do I act? How do I make sure my sleep is good, my marriage is good, my kids have the money they need, how much I have, do I have enough, will I have enough? How can I counter the confusion and the overwhelm? And so I started thinking, what helps people the most is how they behave. And that behavior can really only come through training. But people, it's not a thing in this country to pay for training. And I say training specifically, it's about reframing your entire approach, your entire portfolio. Right, and on the screen here, here's the 2011 correction crash. It's 19%. And I'm going to show you all of the major corrections or crashes going back to 1929. And there's a point to showing you all of these. One of the points is, I'm just going to use the word crash. I think it's kind of a triggering word, but most people do say crash, whether it's because of the pick of the month newsletter world. But it's actually used so many places. Even when I call in to a Schwab, I hear them use the word crash. So we have these crashes. Here, 2008, the S&P falls 57%. Here's 2000, where the market fell 49%. All of these charts I'm going to show you is the S&P 500, right? So there were other indices or indexes or other parts of the world that fell much harder, right? So Europe may have fallen much harder in 2000. Technology fell about 78%. The NASDAQ fell about 78%. So I'm just showing you kind of a global or a general one point of view, but still a significant point of view. And so what I said was, if you get the asset class right, you get everything right, which is true. There was a 1986 paper, Determinants of Portfolio Performance, that said if you just know the right asset class, you know everything. But still, I focused on ticker symbols and not what's the training behind that. What's the behavior to know when you should step aside? Like in 2000, my approach had people stepping aside in November of 2000. So from the S&P point of view, they lost about 11 or 12%, right? And they got back in 2003. And as you can see, corrections happen. Here's 1990. This official is a 19.87% correction, but really I rounded it to 20% because of those 13 basis points. So I want you to see that, yes, corrections happen. Here's 1987, Funny thing about 1987, it actually ended higher for the year. Here's the 1980 25% correction. Here's the 1973 50% correction. So we know corrections happen in the stock market. And we know that when they do happen, the stock market always comes back. The problem is it may take you 5 or 10 years to get back to break even, which is kind of okay, I guess, if you're 30 or maybe 40. But really what's most important is it's more okay, kind of air quotes okay, if your working income is there. But when people get into their 50s or 60s or 70s and their working income is going away or gone away, they can't replenish, they can't backfill that 5 or 10 plus years to get back to break even. And so even though the market does come back, it doesn't help to know that, because at a certain point we die before it comes back. And so the question is, what's the cost, right? What's the cost? Not so much of staying in the market when it falls 37% like 1968 or 23% like 1963, 65, or 1961 when it fell 27%, right? We know there's an emotional cost to that, right? We know it costs sleep. It hurts the marriage, right? Maybe the person who manages the money is attempting to shield the bad information from their spouse, but it comes out in other ways, right? It comes out in stress or not being able to sleep well. It comes out in health. It absolutely hurts health, right? People don't want to worry. People don't want to worry, but it's not the ticker symbol. The ticker symbol is not the answer. And that's what I'm apologizing for, because I believe what's happened is people get the ticker symbol, and then I talk to them years later and they say, yeah, I've had your research for years. It's great. I love it. It's one of my favorite research, if not the most, because it's so powerfully simple and I just love it. But then when I ask them how many positions they have, they'll say, I have 40 or 50. Well, how'd you do in 08? I got really hurt in 08, right? It comes back to the behavior. It comes back to how that person's brain was trained, right? Here's a correction in 1956 of 21%. In 1956 of 21%. In 1946 of negative 23%. In 1939 of negative 41%. In 1937 of negative 51%. And then the big one that most people compare things to is the 1929. And I could go back and tell you about more corrections. There's one in 1919, 1916, 1912, 1907. So I want you to know that corrections happen. Here's a couple interesting things about corrections. One, on average, they happen every 6 years. It's actually 6 years and 3 months. Interesting. Now, average is a weird word because average never happens, right? You had one in 1990, but not one until 2000. That was 10 years. You had one in 2000, then you had one, really, it started in 2007. So that was 7 years later, pretty close to the average. So one thing I want you to take is there is this average, there is this kind of theme, and it has stayed pretty stable over the last 100 years, that there is a correction every 6-ish years. The other thing I noticed that was really interesting about corrections is on average, it's about a 39% fall. Obviously, certain sectors fall harder. Certain size stocks would fall harder. Say a small cap would historically fall much harder than a mega cap. Other parts of the world would fall harder than, say, more developed. What's interesting is that 39% average loss has stayed consistent with the United States stock market over 100 years. I found this really interesting because there have been some major changes in the US in that time period. 100 years ago, I'd say we were an emerging market. Then in 1971, everything kind of changed with the dollar getting taken off the gold standard. So there's just two major marker points, but still the average loss is at 39%. The thing is, I don't want the takeaway to be, okay, there's corrections and it's diversifying. If you've been in my world long enough, you know that diversification stopped working about 20 years ago. It's more about getting the asset class right. But even more so than that, and the thing that's underlying, that supports everything else, is how the person behaves. And what's the cost, right? What's the cost of not acting the way that's best? whether you're managing your money or a big box advisors. What is that cost, right? And this is even true for people who have kind of won, who have done enough things the right way, who may have enough real estate. So if something bad happened, they could sell a piece of the real estate, but they still have 20 or 30% of their net worth in the markets, whether it's stocks or bonds or cash or commodities, in like tradable ticker symbol markets. It still comes down to what's the cost of not losing half of your money. And it usually comes out to better sleep. It usually comes out to, when I do travel, I get to sit in the bigger seats in the front of the plane. I get to enjoy life. I know there's a certainty, right? I know that I will not run out of money. I know that I can, even though my kids might be okay and they're able-bodied and able-minded, but why lose half of your money? Or in this case, 39%, which, interesting, the 2008 correction was 58. The 2000 was 50. I put the 2011 correction in there, which was not officially 20%, but it still scared the heck out of people. And the only reason that stopped falling is because Ben Bernanke came out the day it hit its low and said, I will print another $1 trillion. So the takeaway is, first, it's an apology to you, that the answer is mentoring, right? The answering is coaching. It's to behave in a way that you're supposed to behave when you're supposed to behave that way, regardless of whether you're tired that day or on vacation that day, regardless of whether you're 39, 49, 59, 69, or 79. But it's that you will behave the way you're supposed to behave. That's what I really want you to hear. That's what determines it the most. And when people talk about the cost of not changing, you can talk about it in time mostly, because having to wait 10 years to get your money back is very expensive. That's a decade of someone's life. That's the biggest cost, and that affects sleep. That affects marriages. That affects relationships with kids and parents and siblings, and what type of trips you can go on, who you can sponsor, what nonprofits you can fund, how much you can fund them, how much worry you have in your life. And here's the interesting thing. Even if people have enough, what I notice is their worry does not lessen, right? Even if they had $4 million in real estate and annuities and had $1 million or $2 million in the stock market, because they've never been trained properly on how to manage that, that creates unnecessary worry and stress and anxiety and overwhelm in their life, even if they're quote unquote gonna be okay, because it still creates that. So the cost is much more than the time, is much more than the financial loss, but it's what it's actually doing to our bodies. Thank you guys for being in my world. I did not mean it to be fully a somber thing, but when I go through these losses, I say, okay, losses happen. The market always comes back. But what's most important, and what costs the most, is a decade or decades of bad sleep, years that hurt marriages, worry that maybe didn't ever have to be there. We will have another market correction. No one is calling that a huge insight. The market's been going up since the bottom of 2009. We're 9 years past that. So clearly we're past the average range for stock market corrections. We're clearly past the average range for an economic recession. Clearly we're past the PE ratios being cheap or even of value, but still the price goes up and we follow that. So my offer to you is we get on the phone. We have a conversation to talk about an approach or strategy to eliminate the worry, the cost of that worry, the cost of sleepless nights, the cost of not having to worry about this entire part of your life and how it negatively impacts it. That's a phone call that is free with me, that even that alone brings an incredible amount of clarity to someone's life because they've never actually had that type of conversation with their money, about their money. I want to thank you guys for being in my world. I will do these videos from time to time just so it's easier. I've been told that some of you have missed the connection of the screen and the video and my voice to have me reach out this way. So thank you for being in my world. And I look forward to speaking with you soon. You guys take care.